Do you have an investment property that you want to sell and purchase a different type of investment property, whether it's in the same state or a different state? But there are rules. So what are the rules for a 1031 exchange? A 1031 exchange, also known as a like-kind exchange, is a tax-deferred exchange that allows an investor to sell a property and reinvest that proceeds in a similar or like-kind property without immediately paying capital gains taxes on that profit from the sale. Here are the key rules for a 1031 exchange. Property eligibility. The properties involved in the exchange must be held for productive use in a trade or business or for investment purposes. Personal residencies do not qualify for a 1031 exchange. A like-kind property. The property being sold and the property being acquired must be of the like kind, which generally means they are of the same nature or character. For example, real estate must be exchanged for real estate and it must be located within the United States. Timing. There are strict timelines that must be followed in a 1031 exchange. So you have the identification period. You have 45 days of selling your property to have a potential replacement property in writing to the intermediary. Now the exchange period. You must close on the replacement property on properties within 180 days of selling the relinquished property or by the due date of their tax return, whichever is earlier. So you must use a QI. A QI is a qualified intermediary and it must be used to facilitate the exchange. So the QI holds proceeds from the sale of the relinquished property and uses them to purchase the replacement property on behalf of the investor. Reinvestment requirement. The entire net proceeds from the sale of the property must be reinvested into the replacement property or properties to defer all capital gains taxes. Any tax or boot, non-like-kind property, received in exchange may be subject to taxes. Tax deferral. By completing a 1031 exchange, the investor can defer paying capital gains taxes, depreciation recapture taxes, and potentially state taxes on the profit from the sale of the sold property until a later date when the replacement property is sold without a 1031 exchange. So there are several different exchange types. There are simultaneously exchanges where the relinquished and replacement properties are exchanged simultaneously, delayed exchanges where there is a gap between selling the property and acquiring the replacement property, and reverse exchanges where the replacement property is acquired before selling the relinquished property. And just remember, it's essential to work with a qualified professional such as tax advisors, real estate agents, and qualified intermediaries when considering a 1031 exchange to ensure compliance with IRS rules and maximize the tax benefit of the exchange.